But as your income goes up, what I found is like if you make like 300,000 or above of net profit, it's worth it to have the S corp and just max out your salary to get the foreign
Right.
earned income exclusion. The IRS is basically saying you're not really providing a service, you're just putting money into this business that is generating the income and then you're extracting income. So we're going to limit your ability to use the exclusion to 30% of the net income because you're doing the work.
I own it for 48 hours, and as soon as it gets delivered to the buying group, they scan it, and then I get paid.
So you won't be like a tax resident of a foreign country.
No, one day I will be, because there's an insane tax treaty benefit with France that we can discuss, but it's like a cheat code. It's incredible.
All right, thanks for reaching out, Alex. Great to meet you. Why don't we jump in and just let me know like what's your general situation, what do you have going on, and we'll see how we can help.
All right. So before we jump into the topic we wanted to discuss, I had one general, let's say a general question or confirmation. I would like your confirmation on the topic, and that is, from my understanding, the only way to go truly zero tax as a digital nomad is to have a CFC that's partly only 50% controlled by you and 50% controlled by a non-resident. Is that correct?
I think that is one way. I mean, the foreign earned income exclusion that I'm sure we'll get into is one way is if your earnings like earned income. So if you have your own business, if the income from that business is less than the foreign earned income exclusion amount, that's kind of like that's the first way of paying no U.S. tax as a U.S. expat because you can eliminate all your tax and assuming there's no other income. Um, the next one, yeah, one option is if you put that in a foreign corporation, as long as it's not a controlled foreign corporation, you don't pay tax on the income that it earns until you take money out. So yeah, if you set up a non-US company and it's 50-50 owned by a non-resident and you're not going to pay tax on the earnings of that non-US company until you take the money out. So then you can start pulling out money as say a salary and you keep the salary under the foreign earned income exclusion. You won't pay any US income tax. You also won't pay any US social taxes because you're a foreign company earning foreign income. Again, that all assumes you're not spending any time in the US performing those services in the US, but assuming that's true, yes, that's a very clean way to do it.
Cool, good to know. Because obviously you need um, a a partner who owns the other part of the business. I don't have
Right.
one, so right now I don't have a way to go truly zero tax. So I was looking into, yeah, the foreign earning income exclusion.
Mhm.
The thing is that my activity is is probably subject to the scale back rule and the 30% rule that I guess we're going to discuss next. I was wondering how those apply, because it's not something, as you said, it's not something that's widely discussed online. These two rules, I've only seen it on one or a few websites, but not in detail.
Right.
And tell me if this is, let's say, the overview is correct, but from my understanding, the foreign earned income exclusion applies in full if you have a profession, I guess, and if you're a business, if you're self-employed and you have a business and you have a capital, something related to capital that's involved, then you have these rules that apply that reduce the foreign earned income exclusion.
Yeah, I mean, the foreign earned income exclusion, the first step, or I guess one of the first steps, is that it has to be earned income
Hmm.
and it has to be foreign earned income. So, earned income is wages or self employment income.
Hmm.
There is a rule for like partnerships and things like that where you have to break out the piece you're getting paid for capital versus services. But in your case, but generally, yes, for service based income, it's going to be eligible for the foreign earned income exclusion. So
Okay, so
I guess
you
walk me
said,
through because the terminology is tricky.
what?
I said the terminology can be a little tricky sometimes as far
Mhm.
as like, so what do you mean by this when you say the scale back rule? Do you mean the scale back because you're only eligible for part of the year or the scale back related to like a self employment business? Or
So I
I guess
think,
tell me a little bit about your business, just so I can
okay,
understand like what you're
yeah.
doing.
So I'm my activity is electronics reselling. So I buy all kinds of electronics, iPhones and computers and stuff, and I ship them directly to certain buying groups who buy them at cost or sometimes above cost.
Hmm.
And this year, the gross revenue will be mid six figures with, let's say, about 5% profit margin. But for, let's say, for ease of calculations, we could take an example of 1 million gross revenue and 5% gross margin. So that would be like 50K profit. Um,
Hmm.
we could take an example of with 1 million and 10 million. So that would be 50K profit or 500K profits. And so I looked a bit into this, and it seems like this kind of business is subject to the scale back rule and the 30% rule in the context of the FEIE. And what I understand is that the 30% rule says that either so there's let me try to formulate it.
Okay, yeah.
It's either 30% of your profit margins when you're involved in this kind of business that has high turnover, either 30% of your profit
Right.
margins that are eligible for the earned income exclusion, or the 30% of the average salary for this position you have, and that you can't exclude more than that 30%. That's kind of what I understood the 30% rule was, and the scale back rule. I'm not exactly sure. I didn't quite understand it yet.
Yeah, like from a
Oh
terminology
shit.
perspective, what I the way the scale back rule as I apply it is more based on if you're only eligible for the foreign earned income exclusion for part of the year. So for example, if you left during if you left the US in the middle of the year, um, that you don't get it's prorated. Yeah, I'm just looking up because I wrote an article on this a while back. It's pretty I don't see this as often, the scale back rule, but you're talking about like for a capital intensive business, breaking out
Yes.
what is the earned income versus what's the income earned from capital itself. The 30% scale back rule is that you can use 30% to say that that is the amount attributable to capital, whereas the 70% is attributable to services. Um, let's see. I'm trying to find the article that I read on this just so I can say this specific rule.
Mm-hmm. Because I just ran it through ChatGPT, and it was hard. I had to put multiple prompts, but I finally got it. And it seems like it's pretty bad, but might be wrong. It might be completely wrong, though.
So yeah, this
So I just.
scale back rule, and
Oh,
I'm just pulling up an article that I had written, but it's
mm-hmm,
like it applies where it's the terminology is where capital is a material income producing factor.
mm-hmm,
So the whole objective is that you have to come up with how much of that gross income is related to the personal services you're providing versus the capital. And it's not even the asset itself, but it's the capital that you put into the business to purchase the assets. So in the absence of being able to prove something specifically, the regulations do presume that no more than 30% of the net profit can, or what's considered a reasonable salary that'd be paid out for that services is earned income. So yeah, I mean, I guess the safe, most conservative route is to take 30% of the profit as your
mm-hmm,
earned income. And that would be the only thing that you could exclude. What we would look at is taking like how much could we consider to be a reasonable salary from the business. It's kind of the same methodology. I don't know if you've had much experience with S corps, but like an S corporation in the US, it's the same concept or similar concept where you have to come up with it's really the same thing because the S corp, the whole point of it is that you have to break out what is the salary portion versus what is the flow through income, which is supposed to be related to your capital or not the services you're providing. So it's different there though, because with the S corp, we're trying to justify the lowest possible salary because that's what's going to be subject to the FICA tax. But here we're doing the same thing, and we're trying to justify the highest possible salary piece so that we can justify a higher foreign earned income exclusion. So I mean, depending on the business type, I run like a process for what is a reasonable salary for someone in that business, depending on your earned income.
So let's take an example with 1 million revenue and 50K profit, so 5% profit margins, and then we can, well, let's just go with that for easy numbers. I ran it through ChatGPT, and it says from Treasury regulation, you can take only the smaller of either 30% of the business net profit or a reasonable compensation. So it says the smallest of the two. So maybe, do you think that would still work? A reasonable compensation, which is more than the 30%?
No more than 30% of the profit or the reasonable salary. Let me pull up that reg just to make sure. Oops. Let's see. I think part of this comes down to what is the definition, though, of capital being a material income producing factor, right?
Right.
That's you earned income where capital. So in the case of an individual, reasonable allowance for compensation. But the total amount which shall be treated as earned income of the individual from such trade or business shall in no case exceed 30% of the share of the profits. So yeah, I mean, I guess you're right. It does specifically say the smaller of the two. So I guess you are stuck at 30% of the capital. But let's look at the definition of a material income producing.
What's interesting is that I just noticed here that the 30% rule seems to be in the Treasury regulations, while the scale back rule seems to be in the IRC and Treasury reg. Oh, both.
Is the 30% rule different from the scale back rule? I guess what's the difference as far as terminology?
So apparently the scale back rule is the no double dip rule that prohibits taking both an ordinary business deduction and the foreign earned income exclusion on the very same dollar of gross income. Seems like it is two different rules, the 30% and the scale back.
So the way it works when you're selling a product like that, this 30% rule kicks in when capital is considered a material income producing factor, which just means it's not a very objective test. It just means that capital is a substantial portion of the gross income that's being earned. So capital meaning you're purchasing a product. So you're putting cash into a business to purchase a product, which is then being sold. So the IRS is trying to distinguish between service related income versus income earned from the deployment of capital. To be honest, like this could be a situation where we'd want to look at like the case law around these situations to see if there's a way to argue around capital being the material income producing factor. Because, for example, it gets a little tricky. Like if you're the only owner and you're the only one putting business in, you're providing services for that business. Obviously, that's the reason it's existing. But there is, I mean, obviously, you're making money off of the asset that's being sold. But I feel like what the IRS is more after here is people that aren't really providing services to a business, but rather are just putting income in or putting cash in, and that capital is what's generating the business. So I don't know. We may be able to look into like some case law to see if there's a way that your type of business could try and get around that rule. But I don't know. In your case, it's probably going to be hard to prove that capital is not a material part of the business because that's all that's really happening. It's not really a service
Yeah.
business where you're separately getting paid like a commission or a fee for what you're doing. You're literally just selling a product, right?
Yeah, I mean, there's no
So,
marketing involved or anything. I'm just drop shipping it to some warehouses who buy it from me. But I wonder, would the
right.
e-commerce, I'm not really an e-commerce business because I don't have a website where I sell stuff. But would
Hmm.
e-commerce and drop shipping be considered a capital intensive enterprise?
I mean, to me, honestly, I think there's a reasonable argument we could say that this is a service you're providing. My thought is we'd need to look at the case law around this situation to see if there is an argument that we could say is like I'm looking at some of the cases now. The big examples of this are like larger companies that have employees. I mean, the example in the regulations is like a mining company, which all their rules are so antiquated, but it's a mining company where like you put money into this business, you have employees and equipment in the business. So you put money in, you're spending money for employees and equipment to extract the minerals from the earth and then sell them. The IRS is basically saying you're not really providing a service, you're just putting money into this business that is generating the income and then you're extracting income. So you're not really providing a service in that case. So we're going to limit your ability to use the exclusion to 30% of the net income. But in your
Hmm.
case, I guess, and that's what's weird about these rules is since they are kind of antiquated, it's not really looking at this ability to work remotely or like do what you're doing. Basically it's looking at like brick and mortar type situations, but in your case
Uh-huh.
there's definitely an argument that you're providing. I mean, there's no one else providing services, I guess is my point. So although it is a capital intensive business just in that there's inventory and assets. Um, So I mean, one way to look at like the way it says is where there's a normal return on invested capital apart from the owner's labor that would be expected in that industry. I mean, you're purchasing an asset and selling it, but it's specifically due to the services you're providing, in that
Yeah.
area.
Well, it
I mean,
sounds
to be
like
honest
that
with you,
sentence you read, where it says the owner excluded the owner involvement or something like that. That sounds like it would apply to my situation or to many drop shippers or e-commerce guys or something.
right, like for example, I think another way to look at it is if we took out the services you're providing, there's no more business, So
Yeah.
like
Mhm.
because you're doing the work. Whereas in my example of the mining company, if you take out any services that person's providing, the money they put in is still generating income, So
Mm.
it's not all related to their services. I mean, I'd want to look at this and make sure, like, and double check. This
Mhm.
is an interesting question, but you know, to me, this is still. I think we could argue that this is a service business, not a
Mm.
capital business in the sense that this scale back rule is meant to apply.
Mm. I
Um,
just sent you uh, the three websites where and screenshots of exactly where they mention these two rules by email. Would you mind checking it out and let me know what you think?
yeah, let's see. Where another question on this is it has to be foreign source income. So, the gains on the sale of inventory are sourced based on where the title passes of the company. Well, it depends. Like where are these? I guess the property is manufactured outside the U.S. I assume.
No, actually, I'm buying directly from Best Buy and Costco and all those things online. So everything's happening in the US.
Right.
I'm outside the US, so I guess we could say it's a foreign source income, but all the activities happening in the US. But I don't have dependent agents in the US. I'm not engaged in trader business in the US, I don't think.
Well, I mean, the sourcing, the way the sourcing rule works when you sell inventory is that if it's a product that's manufactured in the U.S., it's going to be U.S. sourced. If it's a product
Hmm.
that is manufactured outside the U.S., then it goes to a title passage rule, where the title wherever the title passes to the property, that's going to be where it's sourced. So if you're selling it on Amazon and that person purchasing it is in the U.S., I think you'd probably argue that that's a U.S. sourced sale. So I think you may
Hmm.
have trouble even making the sale part foreign source in the first place.
Oh, really?
Um, I mean, so but it goes back to how much of the income can we justify as related to your services versus the
Hmm.
sale of the property, you know?
Yeah.
Um, I think that's the first hurdle we got to get over is what is it, do you actually have foreign source income or not?
Hmm. Because I read an article about this from the steward guy. Engaged in trading. And it seemed to say, I'm reading it again, it seemed to say that you could sell
Wait, do
products
you
in the
ever take
US.
title to the property?
I
Wait, hold on
mean,
real quick. Do
I
you ever
guess
take title to the property?
I buy it, I literally buy like any random person can buy on the website at Best Buy. You can buy a computer or AirPods at Best Buy. I literally buy it there.
Right.
And so I guess, yeah, I get the property when the transaction is made.
But you don't purchase it until you have an order from the customer, or do you purchase inventory and then you sell it when customers come?
Uh, there's some deal announcements from these buying groups. And when I see those deal announcements, I will go buy the product and put the delivery address of those buying groups on the delivery address. So I
Okay.
guess it's
So
my
it's
property
not
for
really
just a
like
time
a
while it's shipped.
I see. So you do technically take title to it, like it's yours. If you didn't turn around and sell it, it'd be your property. So when you purchase it, where does it go?
It goes straight to the
Or
warehouse
do
of
you
the buying
have it
groups.
like routed?
Yep.
Okay.
So
So it is,
it's my 24
I
hours
guess
to
that'd be the
48
question is
hours.
do you ever okay, so you never actually like come into possession with it. You send it straight to this buy group
Mm-hmm.
that is then purchased. Are they immediately purchasing it from you? Like that's what I'm trying to figure out is that transaction. So like when you purchase it, you're immediately selling it back,
Yeah. I mean,
or is there
it's
ever a
mine
situation
for
where you're sitting on inventory? You
No, that doesn't happen. I own it for 48 hours, and as soon as it gets delivered to the buying group, they scan it, and then I get paid.
since you own
Yeah.
the property and then it's being sold. Um,
Hmm.
I guess I don't know for sure if there's like a more aggressive approach we can take to say that more of the income being earned is related to your services than it is the capital itself. That's probably a stretch, but I can't say for sure. But
Hmm.
I think we need to. So I think we you may get stuck on that 30% rule.
Hmm.
I'd want to make sure that we actually have foreign source income first. I
Yeah.
think because title is passing on these products in the U.S. I don't know that you're going to have foreign source income to be able to take any foreign earned income exclusion.
Mm-hmm.
Hang on, I'm pulling that back up. Yeah, this is interesting though. I mean, I guess how does what does the income look like when you receive it? Like, is it just like the sale of the product, or is there any, or what does the breakdown look like on the? I don't know if you get like an invoice or a receipt or something.
I just, I mean, I just get a wire transfer from the amount of products
Okay.
I sent. So if I buy 100 AirPods at that cost $100, that'd be 10,000, and they just send me a 10,000 or 10,000 plus 1,000 commission, for example. But yeah, they
Mhm.
don't send me. Let me see. They don't send me an invoice. Uh, I should send them an invoice.
Right. Here's my general take on this is I think that material income producing factor is a rule that we'd have to apply, which is 30% rule. But I think before that,
Mm-hmm.
I don't think that the foreign earned income exclusion even applies because you don't have foreign source income. You have a product that's being purchased and sold within the US. And under Section 861, it's going to be US source income and not eligible for the exclusion. That's if you just do it as you're doing it now. I think if you try to
Mm-hmm.
put this business in a foreign company, that makes things more complicated because now you have a foreign company earning U.S. source income, and you're going to have to file a foreign corporate return in the U.S. And so you're just,
Yeah.
I guess, I guess the only thing, but where I'm going with the company scenario is that you could pay yourself a salary out of the company. So even with a foreign company, yeah, they'd have to file a U.S. Form 1120-F for the U.S. source income. But let's say this business earns $200,000 in the U.S. I would probably let's go the U.S. company route. If you set up a U.S. C corporation, or um, or you could do an S corporation as well. But if you set up a U.S. corporation that sells these products, and let's say you net $200,000 on the sale of this product, you could pay yourself a salary of $135,000 that's specifically based on the services you're providing. So that salary is going to
Mm-hmm.
come from a U.S. company based on services you're providing outside the U.S. So that's eligible for the foreign earned income exclusion. And then you have an additional whatever 70,000 that's going to be stuck in the U.S. and subject to tax. But if you have it in the S corp, it's going to flow through as um, ordinary income, not subject to Social Security and FICA. That's the way I would do it, because then that clearly breaks out the piece that's related to your services. That's going to be foreign source and not. Then the only problem, and it also avoids the 30% rule in that scenario, because then we're just
Mm-hmm.
playing specifically with, we're not messing with the material income producing factor rule. We're messing with, we just have to justify your salary to the business, which I think we can do. We can figure out, I mean, depending on, I think it could be a little aggressive, if like the net income of the business is 150,000 and we say your salary is 135, maybe that's a little aggressive. But I mean, if it is 200,000, I don't think it's unreasonable to say the owner, manager, whatever you want to call yourself as an employee, would take 100 and something thousand salary. But
Mm-hmm.
to me that's, I know it's a little more complicated than originally just like messing with the foreign earned income exclusion rule with the direct business. But I think that would be the way to do this.
I see. Do you have clients? Do you have clients who are digital nomads and who have a capital intensive business like e-commerce? Like I think I saw a few weeks ago you had this podcast where
Uh,
you put a title US expat grills accountant.
Oh, right. Wait, I missed. Sorry, I couldn't really hear what you said. U.S. Expat
Yeah,
Grills a comment is all I heard. Was that a podcast I heard?
yeah, that's what, yeah, the podcast you did with that ecom guy. I think we're back. Yeah, we're back.
Okay. Yeah. No, I mean, yeah, I definitely have clients. I have clients in that scenario with the e-commerce business, but I guess there's two ways to go about it. The more aggressive way to go about it is to ignore the 30% rule. You know, some people skip that step and they just say, okay, my services I'm providing are worth X amount versus what's happening on the sale of the e-commerce property. But I mean, regardless of, I mean, it's going to depend on how that e-commerce company operates, because you could have a situation where a product is manufactured outside the US and title passes outside the US. So now you have foreign source income and it's a totally different scenario than what you have. So, like in your
I see.
scenario, it's US sourced sales that aren't going to be eligible for the foreign earned income exclusion unless we pay a salary. I mean, I guess we could skip that step and we could just kind of say that part of your earnings, like part of the sales price, is related to your salary, but that's just much harder to prove than setting up a separate business that pays you a salary.
What if I ask these buying groups to send me 1099 NEC? I have
Mm-hmm.
1099 NEC with the amount of let's say, of paybacks they sent me during the whole year, but it will be very large amounts since they pay me. It's all my gross revenues comes from them. So, say I sell $1 million worth of products to a buying group, they send me back 1 million plus 100,000. Then, is it possible to have a 1099 NEC with that much, or
With
does
that
that even?
100,000,
Mhm.
I think if we could say that part of the income that you earn is broken out from the sale of the product versus like a commission or fee. So like in that scenario, if you had a 1099 showing the commission or fee portion, then I think that serves the same purpose that we're talking about here. But
Mm.
even then, I think you'd be better off in an S corp scenario. So now, because then you still have, like, so you were able to get 100,000 eligible for the foreign earned income exclusion, but now you still have all of the rest of that flow through income subject to Social Security and Medicare taxes that
Well, it's
otherwise
better to
wouldn't be in
pay
an S
social.
corp scenario.
Yeah, but I guess it's if you're gonna pay income tax on those flow through that are not a salary from the S corp, might as well pay social security tax, no?
Why? So that you're just paying into the
Because
system, you mean?
yeah, because yeah, exactly.
Yeah, if you want to get Social Security down the road, you need 10 years worth of Social Security payments.
Yeah.
Um, but I guess what I was thinking is that if you pay yourself a salary from a U.S. business, that U.S. business is going to withhold on your salary. So if you have an S corp that makes $1 million and you pay yourself $135,000 salary, you're going to pay Social Security and Medicare on 135,000 and take an exclusion for the income tax on that. And then you'll pay income tax on the rest of the income. If you do it the way you're mentioning, you're paying Social Security and FICA. Well, you're paying FICA up to 165,000 and Medicare on all of the income. So to me, you're paying more. I mean, you're paying Social Security and Medicare either way. You're just paying more in your scenario. Which
Hmm.
I mean, yeah, I forget how the formula works for what you'd be paid out, but um, I mean, yeah, we can run it both ways, you know, to see.
Hmm.
I mean, if you want, I guess
Okay.
that'd be the only way to show it exactly. I mean, you could, if you could break out $100,000 on a 1099 to show that that's the commissioner fee, then yeah, you could get the exclusion for that piece, and then you'd pay Social Security and FICA. The other thing is, like, if you're in France, are you paying? What are you doing in France on this income?
Oh no, I'll be back in the US soon. For the moment, let's consider I'm living in the US. And next year I'd like to go full digital nomad for a while. So I will have
Okay. So you won't be like a tax resident of a foreign country.
no, one day I will be, because there's an insane tax treaty benefit with France that we can discuss, but it's like a cheat code. It's incredible. But for the moment I'm not living full time in France.
There's, oh, in France, right? Okay. Yeah. So, because I was going to say, there's also the totalization agreement potentially that you could apply
Yep.
if you were living in France, and then this whole Social Security question goes out the window. But
Yeah.
I think that's your answer: is either you need to find some way to break out a piece of your business income as a commission or fee, so that you can take that part as related to the services you're providing and get the foreign earned income exclusion. One way to do that
Okay.
would be from the company itself, or from Amazon or whatever, whoever's purchasing it, to break that out. Or another way would be to set up a US business. I would suggest an S corp in that scenario, especially if you're going to be spending some time back in the US where you might not be eligible for the foreign earned income exclusion for a period.
Yeah.
That way you can break out your salary very easily, and the rest would be subject to no social taxes. That would be
Okay.
my suggestion in your scenario, is probably the S corp route.
I recall you said I think it was in the Nomad Live podcast that I listened to yesterday. I was in a obsession mode yesterday about this topic. And I think you said that S corps are not usually recommended for digital nomads. I can't exactly remember why, but maybe you recall when you said that.
Right. Yeah, it depends on your income amount. So, I mean, over the last few months, I've been running a lot of calculations for people to see, like, people that have S corps and then they move outside the US. So, I've been running these calculations to see should they keep the S corp or not. And what I've found, which may not be consistent with what I said on the podcast, I don't know, but at lower income levels, it's not worth it, because, like, if you make like $150,000, the S corp isn't worth it, because you the best answer for you is to max out the foreign earned income exclusion, and you're saving very little to nothing with the S corp for a higher administrative fee. But as your income goes up, what I found is, like, and I haven't figured out the exact like break even on that, but like if you make like 300,000 or above of net profit, it's worth it to have the S corp and just max out your salary to get the foreign
Right.
earned income exclusion. And you're still, even with higher administrative costs, you're still benefiting. So yeah, at lower income levels, I don't suggest the S corp. Once you're earning significantly more than the foreign earned income exclusion amount, I would probably say like the 250 to 300 mark, it starts to be
Mhm.
worth the S corp. Um,
Okay.
yeah, that's what the
But I'm
math has
just
worked out with for me over the last few months.
Okay, but that's in both cases, whether you're living in the US or living outside the US. Is that also the case for digital nomads?
Well, if you're living in the U.S., there's no foreign earned income exclusion, right?
Yeah, I mean, well, my question is, would this concept of having an S corp after a certain amount of income, would that still apply for uh, digital nomads?
Yeah, I mean the whole question is, like, if you is are you eligible for the foreign earned income exclusion or not? Is that what you're
Yeah.
asking?
Hmm.
Yeah, I mean,
I mean,
if you're eligible for the foreign earned income exclusion, then what I said just applies. That it only the S corp only makes sense. It's, I guess another way to say it is, it does make sense if your income is, significantly over the foreign earned income exclusion threshold.
Okay, got it.
Because
Yeah.
otherwise, like if you're
So
making $135,000 and we're maxing out your exclusion with the salary, so we're saying, your salary is $135,000. First of all, that's not really a reasonable salary from a U.S. perspective, and secondly, you're just paying full social taxes. So there was really no
yeah,
point of the S corp in the first place. Whereas if you're making 300,000, then it can make sense, and the administrative side um, is worth it.
okay, got it. So just
Yeah.
to kind of to close this chapter, if I get 1099 NECs from the buying groups, we could consider that I have foreign source income, since the what I'm doing is giving them a service by ordering stuff for them and delivering it to their warehouse, as opposed to owning something in the US temporarily that would consider me engaged in trade or business. Or another way to say it, as you say, is mm, it would weigh on the balance. It would weigh on the side of foreign earned income if I have a 1099 NEC. Would that be accurate?
Yeah, and I mean, the 1099 NEC helps, but I think it's more important that basically you just need to prove that a portion of the income you're earning is from service related income and not from the sale of the product. So like if there's some way to, like how would you go about figuring out what piece of the profit is going on a 1099 NEC? You just tell them the amount you
Uh,
want, or
no, it's based on the commissions, I guess.
right. So a commission. So you're okay. So you're earning income on the sale of the product plus a commission. Is that right?
Yeah, yeah. My income is the commission and credit card rewards also, but
Oh, your income's a commission. I thought you're like
I mean,
purchasing a product. Yeah,
I
like how
mean,
would you break down
it
what
is.
your income looks like? 'Cause we just have to prove to the IRS that there's a piece of it that's specifically related to your services. Whereas if we show on your income on to the IRS that you purchased a product for $5 and sold it for 10 and your profit's $5, that's not showing any service. That's showing
Mhm.
a piece of capital that was sold for a profit. But if we show
Yes.
a $5 profit on the sale of that plus a $3 commission, the commission is clearly related to services. But maybe the whole thing is a commission, you know?
I mean, one way to look at it is that these buying groups, they need a lot of people like me to order stuff and ship electronics to their location, because it's hard to place many thousands of dollars of orders from big retailers. So one way we could look at it is say, all right, well, you're giving them a service by ordering stuff for them, and they're paying a commission for you to order it.
I think there's a reasonable argument to make in your case that this is not the sale of a capital asset, actually. It sounds like you're providing a service for these buying groups, and that this could be a a commission or service. I think that's what we need to show in your case. And then this whole problem goes away. Now we have foreign source income again because you're providing a service outside the US. That's what we need to prove in your
Okay.
case is, are we selling a product or are you providing a service? You know,
Mm-hmm.
that's the tricky part in your scenario. Like a lot of the e-commerce people I work with, they're purchasing products from China and putting it on Amazon and selling it on Amazon. And then it sits in an Amazon warehouse delivery place until it's purchased. Your
Yeah.
case, though, it sounds like we may be able to argue that you're providing a service for these buying groups. And if we can make that argument, it's a totally different scenario where it's all service income. The capital intensive piece isn't even relevant.
Uh-huh. That would be amazing if we managed to do that.
I think that's the way I would approach this, as trying to like break down. That'd be the first step, is break down like what are you actually doing, and I guess making a justification for this being a service based business, that you're providing a service for
Mhm.
these, that all of your income is commission, you know?
Yeah. Mhm.
And that's not something I know off the top of my head. I think we'd need to try and find some background for that to see if we can justify. Basically, I mean, you're a middleman, you know?
Yeah.
I
Yeah.
don't know that, so I don't know that I would. I think there's some potential room there to call this whole thing a service business, where you're just providing a service and getting paid a commission for it. The
Yeah.
problem is, I think the problem you run into is that you do take title to the product. I think
Yeah.
that's where the
That's
IRS could like argue the other way, is that you purchased something, it's yours, and then you sold it. You know,
but we could argue that we only
I don't
own
know.
it
There's not.
for 24 hours.
I don't know. It's tricky. I mean, I think we need to run that. We need to run that scenario to see, like, to see if we can find any justification from that in the tax law and case history, to see if that's an option, and then also
Mhm.
what is the risk of that versus the risk and benefit analysis. If we think we might win that argument but we might lose, then maybe we're better off. Maybe an S corp is a safer route, and you're getting to the same answer. You know,
Mhm.
I
Yeah.
guess that's probably where I land, is that maybe we could make the argument the whole thing is a service. I think the fact that you take title to it, even temporarily, makes that a potential issue. It's hard to quantify what that risk is if the IRS were to challenge it. But going
Yeah.
the S corp route takes away that risk significantly, because then
Mhm.
you're just arguing that a piece of it is related to your services, which I think is a much easier argument than saying the whole thing.
Right. Right.
So,
Right. Then
I mean,
there's
that's what
another
I'd say.
part of
Like, if
it.
you're
I
looking for
mean,
like a write
uh,
up or something like that,
what's about the write-up? Sorry.
yeah, sorry, go ahead. I was gonna say, I could, if you're looking for a write up or something like that, I could provide that, like I guess a written memo, like trying to, like, do I think we can justify the service based argument based on what you're doing? Um, and if so, or if, and then compare that to the S corp scenario and what that would practically look like. Um,
Sure.
but yeah. Okay, so if you want, I mean, I can give you a quote on that write up just to see if I think we can get there. So I mean, what I
Okay.
call is like a feasibility analysis, just to show, like, is this a reasonable approach? I guess we would look at both approaches to see how both would work, which one's more reasonable, and then how we would actually implement it.
Got
You
it.
know,
Yeah. There's one other aspect to it. I mean, we don't need to get into the details because, I mean, I don't want to take too much of your time, but just quickly, let's say if I have 5% of my gross margin, and my gross margin is, say, 5%, half of that is in credit card rewards. Oh, shit. It's trying to reconnect again. I don't know if you got that because it got cut off.
yeah, I think I heard you. 5%. So 5% of the income is credit card rewards.
Yeah, half of that is credit card rewards. And credit card rewards are,
Okay,
I mean, usually they're only taxable once they turn into cash because they have unrealized value. And if I only use them to
right.
book flights and stuff, I think that would not be taxable. I mean, that's up for debate, but that's let's say an advantage
Yeah,
of having a business with a high turnover is that all the credit card rewards are not taxable until you redeem them for cash. Like if you buy a flight, they might not be taxable, but if you cash them out against a statement credit, for example, then in that situation it might be taxable.
that's interesting. Yeah, I don't know the answer to that for sure off the top of my head. I would think the IRS has a way of saying that the redemption of a credit card reward, regardless of whether you do it in cash or some other function, is taxable to you if it was received from services you provided. I doubt that just like purchasing a plane ticket from the credit card rewards is not taxable, whereas if you cashed it out, it would be. I don't think that's true. It
Yeah,
it would be hard for the IRS to know and figure that out, but whether it's
yeah.
technically correct or not, I kind of doubt it. Um, but yeah, we could look into that.
I've done quite some digging on this topic because it's a big part of the business I'm running. And
Yeah.
some CPAs have digged into it, and there's pretty limited case studies, I mean, court cases. But I think, yeah, your reasoning is correct. But again, there's a lot of variables, such as how would they know you
Mhm.
redeem those points. Maybe you can show a statement of your credit card rewards, but would the IRS ever ask that is one thing. And then the other thing is that when
Right.
you redeem those credit card points, sometimes they're valued. If you take them as a statement credit, they might be worth 1 cent per point. But if you redeem them on flights, sometimes they're up to 10 cents per point or more. So then would they tax you on the 1 cent per point value or on the 10 cent per point value? That's
Right.
also another variable. So
Yeah.
that's uh, that's what I know about
Yeah.
this
No, it's
topic. I dug
tricky.
into,
The
but I
reason it's
think, I mean,
tricky too. Yeah, the reason it's complicated is because, like you said, it's very hard for the IRS to track that. Like, for example, I worked for a company where I would book my flights with my personal credit card, and then I'd get reimbursed for the flight. But that was giving me credit card points in the process. So, like, could the IRS argue that later, if I cashed that out or bought a ticket with it, that was compensation? I think so. I think that is compensation. Would I ever actually report that to the IRS? No. Like,
yeah,
there's no way they could figure it out. And I wouldn't even know how to do it. I mean, technically, that would be wage income that should have gone on my W 2 or something, but like,
yeah,
nobody's going to do that. But it gets different when like a significant part of your business is the credit card reward. So it's, you
yeah,
know,
true.
yeah, I agree. So I think it'd be more like trying to find a reasonable middle ground in your scenario. But yeah, I haven't spent a lot of time looking at that. I'm just kind of going off like the logical side of it, which is not necessarily the technically correct answer.
Yeah,
uh,
yeah.
a lot of times it's not. But anyway, I got to jump on another call, but yeah, sorry I ended up having to like do a lot of research here on the call just cuz it's not yeah, it's a tricky question. It wasn't exactly the question I was expecting, but hopefully it was still helpful and I'm happy to get back to you like in an email like with a I guess with a proposal to do something a little more technically written up and help you structure it correctly that benefits you
Yeah,
the
well,
best.
I'd be glad to look into that quote. Um, and I really appreciate that we investigated this. It was great. Thank you.
Yeah, for sure. All right, Alex. Appreciate it. Good talking to you. And I'll get back to you in an
All right,
email.
talk. Sounds good.
All
Have
right,
a
see
good
ya.
day, Alex. See ya.